and welcome back to the podcast. Thank you very much for being here. We are going to talk about Silicon Valley Bank today. This is a hot topic, and this is going to be a hot topic for quite some time, I think. So let's get into exactly what happened. And we have to understand exactly what's happening in the banking system and in fractional reserve banking. If you put $1,000 in the bank, they only have to keep $100. They only need to keep 10% of the reserves. I do believe that went down during COVID, but I didn't look before I did this podcast. So put $1,000 in the bank. They keep 100 in case you come back, but they're going to lend $900 out. So if you come back the next day and you want your $900, they've already lent it out. They don't essentially have it. So what they're banking on is that there's a whole bunch of depositors putting more money in so that when you come in, they have the money for you. But what happens is if y'all come in at the same time, they don't have the money. So what happened with Silicon Valley Bank is a whole bunch of people went in and asked for all of their money, which is called a run on the bank. Silicon Valley Bank didn't have all of their money. They may have had 10% in reserves, but people wanted more than 10%. So they had to sell liquid capital in order to get that money. What is their liquid capital? Their bonds. Where were their bonds priced? At 2%. So with interest rates as high as they are today, their bond value went down. So ideally, what they would have liked is for a lot more time for depositors to be depositing money so they could go buy bonds at a higher rate. And then if there was a run on the bank, they would have enough money in liquid assets that they could sell off and they could pay all their depositors. That was not the case. The rates went up and not enough money is coming in. They can't replenish their bond value as quickly as people are wanting money. So they had to sell their bonds off. The Fed stepped in. The FDIC stepped in and said, you know what, we're going to take over. And now today, what happened? Well, this actually happened over the weekend. The Fed said, oh, you know what? The FDIC insures up to $250,000 per person per bank. And so a lot of these depositors, the majority of those that went and wanted their money or had money in the bank, they had more than $250,000 in there. They were over the FDIC limit. So the good old Fed comes in and says, oh, that's okay. We'll make y'all whole. We are going to give you all of your money back. I thought FDIC insurance had a limit. Oh, it does. But we're gonna overlook that limit because it's Silicon Valley Bank. Are we gonna overlook that limit for every bank? So the other thing that I have been reading is that these small community type banks, regional banks is what they're being called. These small regional banks are the ones that are going to be in trouble this time, not the large banks where they have more assets. It's going to be the smaller banks. So Silicon Valley Bank was fairly important, right? Because they had some pretty big people there. What happens when it's a smaller regional bank and it's some of us nobodies, and all of a sudden, they don't cover anything over $250 for us? Now, one would think, oh, Mary Jo, most of us don't have that kind of money in the bank anyway. Oh, I beg to differ. If you are a farmer and you have a whole bunch of excess money, or you've just sold a whole bunch of grain, and all of a sudden you have a ton of money in an account, what's going to happen if your little regional bank decides that they're going to go under? Are the good old Feds going to come in and save us too? Or do we, with our taxpayer money, we just get to save the people in Silicon Valley because they're more important? That's the part of this whole thing that ticks me off more than absolutely anything, is that if the FDIC is going to insure up to $250, then insure up to $250. But We're picking and choosing who we're saving along the way, which is what we always do. So then why do we even have a rule of 250? For the people that can't afford to fight it, are we going to have a banking crisis? I don't know. Should we be concerned? Yes, we should be concerned. Now, I don't know if I've talked about this, but there is a book, and I forget the name of the book, but there is a lady that was in the banking industry, and she wrote a book in about 2018. And she was already talking about the fact that the banks had more debt then than they did in 2008 and 9 when all of this went down. I was listening to the Wealthy On podcast, and I've been talking about this podcast forever on my podcast. And this morning, they were talking about how the regional banks are in trouble. They were talking about how we have more debt to income ratio right now than we have in history in this country. How they are predicting that there is going to be a housing crisis because people aren't going to make their payments. And you might say, well, Mary Jo, why can't they make their payments? It's a 3% loan rate. How can you not make your payment? Well, if we listen to Dave the Dipstick and we do what he says and we go out and get a 15-year mortgage at 3%, our payment is much higher, right? If we would have gotten that same mortgage for 30 years at maybe 3.2%, our payment would be lower. What is happening in this country right now is that people are losing jobs, especially in the tech industry. How are those people going to make their house payment? Because they were told to get a 15-year note. They don't have jobs. And what if they do have a job and they can go refinance that loan? Probably it's going to be 6%, right? Banks are losing money hand over fist with these low interest rates because they have money in investments that are 2-3%. And they don't have enough money coming in because why? We have this massive inflation and all of our stinking money is going to buy groceries. We don't have money to be depositing into the bank. We're lucky we have money to go to Walmart and buy what we need for the week. They were talking about this very subject on Wealthy On as well the other day on a podcast and he was interviewing a lady, which isn't normal. So you can go back into their podcasts and find this. But she was talking about how they have manipulated the numbers to make us believe people are still buying things. When in fact, people are not. They say people are spending more money. It's all good. The economy is fine. Well, the economy is not fine because people are spending more, but they're not buying more items. It's just that the items that they have purchased are costing more. That is a fake look at what is happening in this economy. So let's go back to infinite banking. What did Nelson say? Don't do business with banks. Because if we allow them to do fractional reserve banking, they can lend out 9 times what they got in. And they just keep on lending and they dig themselves this huge hole. What happens when we do IBC is we are not allowed to do that because the bank is not, or the life insurance company does not get to keep 10%. They have to keep 100% of what we put in liquid and accessible to us. So they don't have this immediate deficit that they have to go scramble to be selling off liquid assets that are worth basically nothing. Here is what I saw last week as well. And for those of you that are listening to this on the Farming Without the Bank podcast, this is a big deal because we are going to be looking at another farm crisis of the 80s. And you can call me crazy. And if I'm right, I'm going to be sorry. I hope to God that I am wrong. But in the 80s, what happened? Banks came in and said, you know what? You can't make that land payment. That's okay, Mr. Farmer. We're just going to refinance that for you at 20% interest. Instead of working with the current loan rate of 7 or 8, we're going to just refinance that to 20%. Well, Mr. Farmer said, Mr. Banker, I can't pay the interest on that. Well, Mr. Banker says, that's not my problem. I guess we're going to have to sell your land. Last week, I had a lovely gentleman that I talked to, and he is upside down on his payment due to drought in his area. So he has to sell some land. He has to put $400,000 down on his land loan when he sells the land, which then the bank should just go in, recalculate that payment, lower his payment. All should be good in the world of banking, right? No, 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 no. They told him, as soon as you put that $400,000 down on that note, we are then going to refinance it to calculate your new payment at 1% higher than what you currently have. Sounds to me like the start of the 80s farm crisis again. Does it not? The banks are going to be calling these notes however they possibly can. Now, I don't think that they can call a note if you are making your payment. There's nothing they're going to do about that. But the second that you get behind, they're going to find some super creative way to increase that rate. And this is the third client that I have that this has happened to. The third one, not to mention all of those that I have to talk to on the TikToks and the Facebooks, okay? This is happening. It's not necessarily crooked banking. It is banking. And it is the reason why we are creating the pool of money in the policy. Now, I actually had a visit with a client today that said, you know what, Mary Jo, I've just been letting that money sit in that policy. But now that my operating is at 9.25, I think I'm going to use that, right? How high can that go? And he's been waiting to use it as a land down payment. So he's being smart about it and he's been building it. He could have been using it along the way, but I have a great number of these clients who have been building this over the last 5 to 10 years, 13 years. And all of a sudden now the interest rate has shifted. And it has given us the ability to borrow money from the company at anywhere between 4% to 5.28% today so that we can access that money cheaper through the policy. So many people in the meantime of the last 10 to 14 years have said, you know what, Mary Jo, you're an idiot. Why would I put money into life insurance and borrow at a higher rate than what the bank is offering me? As if the banks are going to continue to be low interest rates. I don't know what would ever make us think that's going to happen. Now, if you continue to listen to the Wealthy On podcast, they are talking about the fact that if rates don't come up higher, even higher than where they're at, we are going to have 10% inflation. So rates need to come out to bring down inflation. When are they going to peak? When are they going to do this? This bank failure is just the beginning of what happens with low interest rates when we are buying assets at such a low rate. And now that is a devalued asset because everything that we can buy today is higher. It's like buying cows high and selling them low. That is not how you want to do that. That is not how banks want to operate. The fact that they don't need to keep money in reserves is what got them in this problem to begin with. If the bank had to keep 100% of your reserves and make better financial decisions, there wouldn't be runs on the bank. They would have all the money people deposited. Fractional reserve banking is the problem. Don't do business with the banks. Life insurance companies can't do that. They can't inflate our dollar. There can't be a run on the life insurance company because they have the money there. Now, if we all went to the life insurance company to access money, which you should not do, just like these guys should not have all gone to Silicon Valley Bank. If they wouldn't have all gone to Silicon Valley Bank to get their money and they wouldn't have all freaked out, we wouldn't have this problem, right? But everybody freaks out at the same time thinking the money's going to be there. Hello, it's not. But if we do that with the life insurance company, they're probably not going to get us our money in 10 days. It's probably going to have to take a little bit longer. They're going to have to sell off some assets as well to do that because the asset's sitting there. It's just not been sold, but they're not doing anything with it. They're not spending it elsewhere. They know it is sitting there in reserves waiting for you to access it. That is not the case at the banks. It is a much, much different story. So, as people are asking me about what's going to happen and how does this relate to infinite banking, it is why we do infinite banking. It is not for rates of return, it is not for arbitrage. It is for us to have control of that money. It was Nelson's purpose. He had two purposes in life. One, spread the word of God. He was a very extreme Christian man. He wanted you to understand that first. Two, get rid of fractional reserve banking and the Fed. Cut government in half. Look at what they did. They came in and bailed out all their buddies. I'm not their buddy. I'm pretty sure I'm not going to get bailed out. $250,000 is not a lot of money to a business owner and a farmer. A lot of us have that kind of money sitting in the bank waiting for inputs to pay for fuel, to pay for fertilizer. And it doesn't have to be today. What happens when it's the end of the year? What happens when it's the day after you sell cows? What happens when it's right shortly after you have a great payment or sign a new contract for your business and you get this big payment in? If we haven't spread that amongst banks, we are going to be in trouble as well. And so creating your infinite banking policy will give you access to the cash. You don't have to worry about a run on the banks. The policies, the companies have always been there when these sort of things happen. This is interesting as well. I was reading, I believe it was a CNBC report, and they said that bank failure is uncommon. It is not normal. Only 4 banks failed since 2020. Only 4? Well, let's look back further and even further than that. And there are bank failures all the time. The last 2 years, we've not had bank failures. Before that, we had 4, we had 3, we had 20. I don't remember exactly what the numbers were. We have had a lot of bank failures. If life insurance companies failed like that, we would have an issue. But guess what? They don't. Because if a life insurance company is not doing well, another company will typically buy them out 99.9999% of the time. And guess who's not going to bail them out? The Federal Reserve. They're not going to get bailed out. The government's not going to bail out a life insurance company. It's a private company. They better figure out how they're going to bail out themselves. These banks don't need to manage their money. They don't need to keep big reserves. They don't need to do anything because they know good old government will come in and save them. That's not the case for life insurance. So again, when people are talking about why would I be doing life insurance? This is no good. Whole life is no good. Really, are we holding whole life to a different standard than we're holding the banks? Oh, I do believe so. Because you think that the life insurance companies should be all that and more and magic and have everything perfect. When was the last time you walked into your bank and said, I want to see your books? And is everything all good and perfect? Because you actually have the majority of my money. Have you asked that of any of your financial advisors and their companies, JP Morgan? Or whoever the investment people are, Edward Jones. Sorry. Have we asked that of them? No, but we asked that of life insurance companies. There is a huge double standard here. That has to stop. If you're going to ask it of life insurance companies, I'm happy to give you the information. And I'm happy to do that because they've survived. What I'm not happy about is that you're not asking that question to everybody else. Would we all be a better society if we did ask that question and hold them accountable? 100%. Okay. I could probably go on about this forever, but that is where I'm going to stop because those are my thoughts. So make the bank plan B. Plan B. Plan A should be building your banking system so when these things happen, it doesn't fall apart. Getting rid of the bank. Do not do business with the bank. And I will add, unless absolutely necessary. There are times that we have to, but we have to be super smart about it. And these runs on the banks, I don't quite understand them. I don't quite understand why we're all getting together and going in and I get it. I understand that we're scared about our money, but we have to be logical. It's kind of like toilet paper, right? We all think we're going to be out of toilet paper and we're out of dang toilet paper. If we just don't freak out, we have enough toilet paper. We don't freak out, the bank won't have a run on it. Same reason why we don't freak out about life insurance companies and have a run on the life insurance company. Hey, if you guys have more information on this, I obviously will be watching it, and let's hope not a bunch of other banks go down. but don't have more than 250 in one bank. Go spread your wealth. Do your thing. But, maybe they'll save you. I don't know. I don't know. This is why life insurance is super important. This is why we use it as a warehouse to wealth, as Nelson called it. If you have not gotten that book from him, you should go do that. If you've not gotten either of my books, go to withoutthebank.com or farmingwithoutthebank.com. Grab my book, Nelson's book. There's bundles on there. There's audios on there. Grab them all and schedule your appointment. At the time of this recording, I am booked out until May. I apologize for anybody that has to wait, and I am thankful for you for waiting. It has been crazy busy because of what has been going on in the market, and people are finally seeing that they do not want their money there. We keep losing money, and it sounds to me, according to the Wealthy On podcast, that is just going to continue as a cycle for the next year, most likely. And so people are sick and tired of it. So I am smoking busy. I appreciate you waiting for me. If you go to a local agent, which a couple people have, I'm seeing their stuff and it is not correct. Oh, it is so wrong. Do not call an agent and say, hey, this is how much money I want to put in. So that happened to me the other day as well. Somebody called and said, oh, I talked to another agent. I told them how much money I want to put in. By the time we were talking, I'm like, why? Why that amount? That is not going to get you where you need to go. That's not going to meet any of your expectations. You really should have consulted. And so we redid everything and it's all good. But be patient and wait. It will definitely be worth it. In the meantime, if you're saying, oh my gosh, where do I put my money? Listen to the Wealthy On podcast right now. When last I heard, they were saying, go to bonds, go to money market, go get it out of the market. That is their advice, not mine. So go there and listen. But if you don't want it at risk, there may be some of those options. Put it in a brokerage account. Do something that just alleviates it from the market crashes. Yes, you could buy, it's on sale. I'm not even going to get into that. So let me know if you have comments, questions, concerns. None of this was financial advice. I am not a financial advisor. So just telling you what I hear, sharing that information. If you need me, Mary Jo at Without the Bank. Otherwise, you guys have a fantastic rest of your day.